really feels like it was a day, especially with the jobs data, Abigail, where some said, okay, maybe that means fewer rate hikes, and others looked at that and said, okay, the recessionary risks are front and center. It's time to unload some of the best performing stocks. What's been your assessment?
Well, it's amazing because we have this continued tension between the markets and the Fed, and that's been the case for quite some time. You know, on a longer term scale, it seems that folks are either not fighting the Fed or they're fighting the Fed. In the case of bond investors, they've been fighting the Fed, at least to my take, over the last, let's call it, year or more, because based on what I have heard the Federal Reserve say and do, they are very clearly hiking. Loretta Mester right there just saying that the Fed is planning on hiking to make sure that inflation goes away, that there is the chance that it could stagnate somewhere, in the current range, and that they're not going to take risks around there. Fed Chair Jay Powell in the past has said that they will be hiking longer, even if the hikes at each meeting are shorter. Yet when I look into the Bloomberg terminal, we're looking at the possibility of cuts later this year. But this isn't news. We've had this back and forth where the Fed continues to give the same message that they are in tightening mode, even despite the recent banking turmoil, that right now doesn't have too much of an effect on what they're doing outside of some of the special facilities that they created. And yet you have these cuts. So it's interesting, last year, of course, we had when yields were up, stocks would go down. Right now, we have yields down. I think a lot of folks out there think it's because of a recession fear. We do have some economic data that's coming in lighter than expected, but let's face it, we still have services in expansion territory. The jobs report, of course, on Friday will be key, Creedy, but I would note that right now it doesn't seem like the economy is falling off the cliff. So I think that some of the action that we're seeing in bonds, yields, actually gives the Fed a lot of room if they do want to keep hiking as they've signaled, and it also gives markets a lot of room, because if they do stay lower after the 2-year yield having been at 5%, the 10-year yield above 4%, it means that those rates could be digested on the way up, where stocks stay sideways as they've been over the last year, or maybe even break to the upside.